Most small business owners know they need a budget, but a useful budget is not just a spending limit, it is a management tool. A good budget helps answer three questions. What do we expect to sell? What should it cost us to deliver those sales? And will we have enough cash at the right time to pay employees, vendors, debt, taxes, and operating expenses? That is where budgeting becomes more than bookkeeping. In a well-managed business, the budget starts with expected sales volume and pricing. From there, we can estimate the materials, labor, overhead, and operating costs needed to support that level of activity. But the real value comes after the month ends, when we compare actual results to the budget and ask why were the results different. That process is called variance analysis. For example, if material costs are higher than expected, the answer is not simply materials went over budget. A more useful analysis separates the issue into two parts. First, a materials price variance. Did we pay more per unit than expected? Second, a materials quantity variance. Did we use more material than expected for the actual level of work performed? Those are very different issues. If the price variance is unfavorable, the problem may be vendor pricing, purchasing timing, tariffs, freight, waste in procurement, or outdated estimating assumptions. If the quantity variance is unfavorable, the issue may be job site waste, poor estimating, rework, theft, spoilage, or operational inefficiency. Labor works the same way. If labor cost exceeds budget, I want to know whether the business paid a higher wage rate than expected, which is a labor rate variance, or whether the work took more hours than expected, which is a labor efficiency variance. A labor rate issue may point to wage pressure, overtime, or staffing mix. A labor efficiency issue may point to scheduling problems, training, supervision, workflow, or estimating errors. That is the difference between seeing a number and understanding what the number is telling you. Another important concept is the difference between a static budget and a flexible budget. A static budget is based on the activity level you originally expected, while a flexible budget adjusts the budget to the actual level of activity. That matters because a business that sells more than expected should also expect certain costs to increase. The question is not whether costs increased, the question is whether costs increased more than they should have for the actual level of sales or production. That is where many small businesses miss the mark. They compare actual results to the original budget, but they do not adjust for volume. So they may think they have a cost problem when they really have a volume difference, or they may miss a real efficiency problem because sales were strong. Cash planning is just as important. A business can show profit on an income statement and still run out of cash. That is why a cash budget looks at expected cash collections and expected cash disbursements. When will customers actually pay? When will payroll, sales tax, income tax, loan payments, inventory purchases, and vendor bills actually come due? And will the business have enough cash during slower periods or growth periods? Growth can create cash strain, especially when the business has to buy materials, pay labor, or carry inventory before customers pay. This is where my work as a CPA goes beyond basic bookkeeping. Bookkeeping records transactions, tax preparation reports historical results, but strong financial management connects the budget, the income statement, cash flow, and operating data so the business owner can understand what happened, why it happened, and what to do next. For small businesses, the goal is not to create an overly complicated corporate budgeting system. The goal is to build a practical financial roadmap, expected sales, expected costs, expected cash flow, and a disciplined process for reviewing variances. Because once you understand whether the issue is price, volume, efficiency, timing, or cash flow, you can make better decisions. And better decisions are what turn financial statements into management tools.